Today we talk about building wealth. Now, I'm just a dude in my 20s. If you expect me to have every single answer, well, you're wrong. All I can give you is my take on it with my, perhaps limited experience. I am not looking to sell you shit. I don't have a course. This is not a seminar. In this space where people discuss these types of things, almost everyone's a scamming scumbag. I just think it's a crucial thing to consider when you watch my other videos. I notice a lot of questions and people who don't quite get what I'm saying because perhaps I never created the necessary context. And so I'm hoping that this will give you my baseline views on all that, and then we can refer back to that depending on future videos. So again, I'm not saying I have all the answers. This is just me with my experience so far, and who knows what else evolves from here. Beyond that, this is not about politics. This is not financial advice. This is not me saying this is good or bad. This is just how I see the world being right now and how I believe I should go through it. I'm aware this will not be a super popular video. It's not me overreacting to ghosts from the past or some fucking BS like that, but I think it's very, very crucial. I think this is important content. So the way I see it, we have two sides. Both sides need to be in order for this to work long term. Again, there will be people who do not have either in order, and in the short term, they may be showing you how amazing they're doing, but again, longer term, there's a few key concepts that, as far as the data goes, as far as the bunch of books I've read and the people I've watched and tried to learn, that all keeps on lining up. Let's call this our attack and our defense, since we're still a Yu-Gi-Oh channel, right? In a book like Millionaire Next Door, they would maybe call it offense, defense. In a book like Rich Dad, Poor Dad, I'm sure they'll name it something else. Core concepts remain the same. You have your side where you look towards your actual income. How do you generate capital in some way? And on the other side, you look towards how do I not lose that income? Now, when it comes to losing, there's a bunch of ways you can lose money. The first one would be just spending it on dumb shit. So saving is part of that defense strategy. Making sure that you're not spending on every single shiny card that you want to put in your deck. Making sure that you're not spending on the most expensive Starbucks. Making sure you're not spending on going to restaurants or parties 24/7. All of that stuff is part of the strategy. Making sure that you're not spending on fucking the newest car and the newest this and the newest that. There are people whose offense strategy, so the attack, are doing great. Like a professional football player who makes millions, but then he doesn't realize that in a few years he'll be forced to retire because of how much physical strain all of this takes, and he can't do that for years on end. Most football or professional basketball or whatever sport they're into, baseball, usually these careers don't last long. Maybe there's one sport I just named where it does, but you get the gist. These short-term booming insane careers, but then they match that with insane spending like multiple Lambos and estates and so forth, and then as they retire it all comes crumbling down and they turn out broke. This is something you see often with these massive earners, and so their offense strategy, their generation of capital, their cash flow was great, but because they never considered how will I make sure that I don't spend it all and that I don't lose it all in some way, wasn't in order, they get fucked. We've seen this over and over and over. So when we talk about the defense strategy, saving is one of them. Now beyond that, if you just save money and hoard it in the bank, you're also gonna get fucked. Because inflation exists. $1 over time will be worth less than right now. Whether you argue that, oh, the normal rate is 1.76 in my country, or some people say, no, it's actually way higher. If you factor in housing, it's actually 4. Okay, you can argue about this all day if you want. There are thousands of papers written on this stuff. It's very complex stuff, but inflation exists. And so if you just let your dollars rot away, you will be left with nothing. The one way to ensure that you are going broke is never investing at all. Be aware that once every X years, your value you have in dollars halves. And that X depends on, how harsh the inflation is for your country, situation, era, and so forth. If you look at the defense strategy, generally people like to talk about compound interest. If you put $100 into the stock market, then 1 year it'll give you X%, and then the next year, because your amount of wealth increased, the interest that next year will be higher because you have a higher basis. And so every single year that interest will roll over and you'll end up with Well, a way higher number. That's compound interest. Now you could argue the same thing happens with inflation, you know. Your inflation might be compounding. It's not exactly the same. Let's not get into the details here, but be aware of that. Even if you make a truck ton of money because of whatever, maybe you had loads of luck, like a lottery winner, those very often go broke as well. Even if you save properly, inflation will destroy you. So there's a lot of facets to this defense strategy, but that's what we're going to be talking about here. So going back to that offense, the generation of capital in the first place, or well, cash flow, whatever you want to name it. Your offensive strategy is literally, how do I make money? Do you have a well-paying job, perhaps? Cool. Maybe you went to some prestigious school, got a really good degree, got a really easy way into a really good company, and now you just get your promotions and you move up in life, essentially. Awesome. Then your offense strategy might be in order. Maybe you're a doctor. Then your offense strategy probably is in order and you're probably making pretty good money. Now, of course, maybe you had to take on loads of student debt. If you're in America, for example, and beyond that, you probably had to study way longer than others. So for the longest time, you were accruing debt and not making anything. So your compounding interest, if you start investing and once you have wages and so forth, actually started later. Something people often don't realize is, let's say you learned a trade, you know, a carpenter or whatever trade. Very often they went to trade school, right? In my country, that would be from 12 to 18, I want to say. That's when you go to trade school. And then you instantly start working. Now, if you are a doctor from 12 to 18, again, in my country, you went through high school and then you had to get into university. From there, in order to become a doctor, I think you need like 7 years. So if you never failed any year, everything went great, never had any accidents whatsoever, you only start working at age 25. Now, technically, sure, once you get out of that education, you will make more than whatever trade school person started with, but that person has been working for 7 years. If said person who has been working for 7 years had also been saving and investing, once again going to that defense strategy, the interest he would have accrued from the market will have already started compounding 7 years before the doctor even got his first cent. Add to that the fact that you have student loans and so forth. If you are in America or maybe the UK, again, it depends on where you live. If you're Danish, maybe you don't. That really puts some of these doctors, you know, further back in many ways. However, it is easier to catch up as generally you do make more. Now you could say, sure, the trade person could also start a business. And yeah, we'll get to that, right? But if we're just starting as base level, you're an employee of company X, sure, the doctor could catch up. But just saying, if your defense strategy is in order, even on lower income, but you start investing sooner than others, maybe the compound interest can actually make you catch up in very magical ways. But we're getting sidetracked. Back into the offense strategy, right? If you're a doctor or something, you probably have a strong offense strategy already. You have solid income because of your very amazing profession, right? However, there are many doctors who are still getting fucked because sure, they work their ass off and now they feel they deserve X, Y, Z. And maybe they do. Again, I'm not one to judge, but if you then go to vacation 1, 2, 3, 4, 5, 6, 7, and you have this car and this Dodge and this Porsche and this that, there are many doctors who actually don't have much wealth to their name at all. So while their offense strategy may be going great, their defense wasn't in order and so they crumble. Same shit with the football player or whatever sport that doesn't last long. You know, there's some sports where you last like 5 years and you're out, right? There are plenty of stories of guys making millions, never really caring about this corner going broke X years into retirement. This shit really happens. Same thing with artists. And so once again, their offense strategy was fine for the time, but because their defense was never in order, they still got fucked. So you have your occupation, obviously. On the flip side, in your offense strategy, you might have a business. Maybe you own a company. Maybe you have an insanely great idea that came to fruition, and that way you have sickening profits, really good cash flow, whatever. That's an option as well. But of course, those are more rare. It's more rare to have someone with a lucrative business than having someone with a regular, well-paying job. You know, the risks are different and so the reward is different, but I'm not a career advisor, right? Now, one thing you could also talk about is alternative cash flows. Maybe you are a teacher by day and a photographer in the weekends, you know. Maybe you do teaching as your main income. And then on the side, you have some kind of passion project that you still get some income from. You have a lot of YouTubers who actually live that way, you know. Their main job is something that's maybe boring but pays the bills, but then on the side, they get a little bit of extra income from doing that. There's also people doing multiple things. Maybe you work in a bakery just to get by and that's your thing. And then you are a photographer. And on the side, you also have a YouTube channel. And so the photography maybe brings in 400 a month. And maybe the YouTube channel brings in another 200 in the month. And so having multiple forms of cash flow can be really good because on one hand, you're no longer hedged entirely on one occupation. If you right now, during COVID, are a restaurant owner and that is your only income, you are hurting. And that is not your fault. Like, technically, you did nothing wrong. It's just shit happened and the government said, close, shut the fuck up, you're not making money, too bad, figure it out. That's not in your control, you got fucked. If you were a restaurant owner who also has a few other forms of cash flow, in whatever way, maybe you have a YouTube channel on the side, that could be good. Now, I'm not saying every restaurant owner should have a YouTube channel, duh, but it's something to think about. Me personally, I've never counted this actually. I have a YouTube channel like this one. I have another channel. I have my two businesses. I technically have referral links to products. Say, like if you have a following, you can say, oh, here's a product that I recommend. It's a good product. And if you're interested in it, you can go buy it. And then whenever people buy it, they could pay you for that. You know, you recommended a good product. So the company is happy that they had to spend less on advertising. And so they give you a little bit of money. That's called affiliate marketing. That could also be a form of income. And so by stacking all of these different kinds of income, you're just increasing the viability of your offense strategy. Not only is there more cash flow, there's also diversity of cash flow. And so if you got fucked by whatever, it could be COVID, it could be something else. We go back to the carpenter or maybe the surgeon. If you're a surgeon or a carpenter or whatever, you need your hands and then you have an accident and you break your hand. Now you are out of a job for X amount of months. Surely you could say, oh, but we have insurance for that and so forth. True, but why not be insured in other ways? And so once again, I'm not telling you need to have extra forms of income, but it is useful to consider. Most wealthy people that you look up to, you go, wow, how did they do that? Usually they have multiple flows, whether it's from real estate, rental properties, whether it's from they own a company and so forth. They very, very often have these extra forms of income. So that's something you want to look at. This part of the chart, I wish I had a whiteboard, honestly, I should install a whiteboard. This part, the offense strategy, is the thing people usually look at because it's the sexiest, you know. You'll see a video of a guy going, oh, how I made $1,000 in a day, how I made $100,000 this year, how I made this, how I made that, and that's sexy. But if you then go around and spend it all on a Lamborghini, there's nothing left. You don't have wealth. The second you drove that Lambo off the lot, you already lost 30%, and from there that Lambo is only losing you money. Then we basically get into the discussion of assets versus liabilities. That should really be a different video, but the TLDR is that an asset is something that produces income and a liability is something that costs you money. So getting the difference between things you buy that are assets and things that are liabilities can be really useful. The offense is very sexy. Everyone wants to talk about the offense because, you know, ooh, I made this, I made that. Whoa, look at me, I'm so wealthy. Then we get into the defense. The defense is the least sexy because if you want to keep anything you make, well, you gotta save it. And that's not fun. It's not fun. I wanna buy all the blue ices. How can I do that if I need to save, right? But it is crucial. So once you've saved, then you wonder, what the fuck do I do with this money, right? You know that if it sits in the bank, it's gonna rot away. Inflation will eat you alive, and once every X years, depending on how many inflation there is, your dollar just lost half of its value. By the end of it, you know, if you just nicely saved until you're 80, unless there's heavy deflation, your money will not be worth shit. And of course, 80 is a bad example because then you will get people going, oh, but at 80, you can't even do anything with it. I want to spend it all now. Okay, fine. You can also talk about 40 and 50 and so forth. But fact of the matter is, if you save well, that's great. But if it's not growing in any way, then you're still gonna be broke. So we move into investing, also known as buying assets that appreciate, hopefully in a way that should not only beat inflation, but also make everything grow. This will make it so the compound interest will roll over, and over time, everything will grow exponentially to a point where a lot of old people are very wealthy just because of time. They saved, invested, they never even made a lot of money. Their offense strategy wasn't outrageous. They were no doctors, they were no rock stars. All they did was save, invest. The capital kept on rolling over with compound interest, and after a while, that graph just goes up exponentially. I think for fun, everyone in their life should go to Google, type in compound interest calculator, put in a number that you think you can save per year. Maybe it's 5,000. That would mean you save slightly under 500 a month. You put that in. I don't know if you can. Again, it could be higher, it could be lower. Then that's also the amount you put in every year. So 5,000, 5,000. And then for the percentage of growth, let's say 7%. 7% is the average the US stock market has returned over a long ass time. Now, some people could say, oh, it's actually 10 because I look at these years. It's actually 8, I look at these years. Sure, just take 7, the safe one. And if you don't want to see 10 or even 12, if you want to get really excited, check that out. And then put in 30 years. Just see what 30 years of saving would do. How about we do that right now? That's going to be a fun one, right? Right, so our current principal is 5,000, annual addition 5,000, but again, it could be more, it could be less. That's not what this is about. We let it grow for 30 years. If you're looking at this in your 20s, maybe you'll be somewhere in your 50s by then, interest rate of 7%. If you let that grow, you will have $543,426. That's quite a lot, right? Generally, a lot of people could afford to put this amount away. Now, a lot can't, shit stuff. Millennials don't own a lot of wealth compared to boomers back in that age. We've seen all the articles, and I don't want to be insensitive to that reality. But in general, notice how a fuck ton of wealth was created just by letting time do its work. Now imagine, instead of 30 years, you put down 40, as we're gonna do right now, then that 543 turns into 1,100,000. So $1,142,920. Notice how adding 10 years more than doubled what you would have. That shows you how powerful time gets the more you let it work for you. If you put that 40 to 50, but again, now you're getting into a time horizon where you may say, I'm so old then, what do I even do with the money? But regardless, just showing you what an extra 10 years does, that 1.1 million then becomes 2.3 million. Once again, more than double. So once again showing there's a lot of old people who never did any of the super magical stuff here, just saved and invested in a very, I would say moderate kind of asset allocation and still did extremely well. So now we established you need to somehow get your offense in order, right? If you don't make enough to even get to saving and investing, something there needs to change. Either your expenses need to change. Maybe they're high, maybe they're low. Maybe the offense just isn't powerful at all. I guess something needs to change. Now again, you could say it's the system that needs to change, and I'm not even interested in arguing that. You could go on about this for hours, but this is what it is right now. So your offense needs to change. There's a lot of fucking scammers out there who will promise you shit. Don't listen to them. Look to the tried and true, the proven methods, let's say, like bank robbery. No, don't do that. But assuming you somehow now have accrued enough cash flow to a point where you can save and then invest, then you look how. Now, the first thing you want to do, in my opinion again, is building that emergency fund. You will be buying assets that will swing up and down, right? So if your offense strategy somehow gets fucked, again, if you're a doctor and you're a surgeon and your hand breaks and your insurance doesn't want to pay and something goes wrong, you don't want to be forced to sell those assets from the defense category we just spoke about, maybe at a loss. If you are entering something like, again, the cardboard, sometimes that market will be down. And if your offense strategy getting fucked happens at the same time as the cardboard being down, and often they can be linked, like a black swan event or a big crisis, everything is down, maybe because of that you lose your job, you don't want to be forced to sell assets at a loss, because that will instantly wipe out so much. If you were forced in 2008 to sell stocks 30 or 40% off, you got fucked. Good luck letting time work for you when you're forced into that. So because of that, you need to have a level of savings that will not grow you know will get fucked by inflation. But you just need it to keep yourself together in those worst times. Because if you don't, well, maybe you get lucky and maybe you just have even more invested and you never need to reach into your emergency fund. Great. But if you're not one of those lucky people, now you're fucked. Now you need to sell all your assets. So you start with that emergency fund and then you look towards the tried and true. You look towards stock. You know, owning some kind of stock, it will pay you a dividend, or maybe it's an accumulating fund. So that means a dividend gets reinvested over and over. Maybe there's a piece of real estate you are able to buy, you know, if your offense strategy is real good to a point where you have the capital to even buy real estate, or maybe you saved so much, that's also a thing. Maybe your country has really solid bonds, but personally, I'm not a fan of bonds. Right now, interest rates are very low, so it doesn't really give you much. In my country, it also gets taxed to shit, so I'm way more in on stocks. But you basically try to build a foundation of legitimate assets, time-proven assets, where you know, okay, I can expect a 7%, an 8%, maybe even a 10%, who knows? Something that will make it, so you know, okay, I will have returns around the level of the market. Because as we already showed, even with a quote-unquote tiny amount of savings, I know it's not tiny, but it was just a solid example, over time, that compound interest will do its work. And for most people, this would already be enough, honestly. If you have all of this down, and you then reach this point, fine. Now, personally, what I like to do, but that's just me, and maybe in 30 years I'll go, oh, fuck, I regret doing that. Or maybe in 30 years I think, whoa, it was really smart doing that. Then you can still have a very tiny sliver, a very tiny portion of your wealth beyond the proper established everything into something more speculative. Now, I'm no financial advisor. If you need financial advice, go to one. This is no advice. Then you can get into play money. Maybe 2% of what you're investing or 5% of what you're investing can go into something that you think will have insane upside because it's so inefficient, so undervalued, but you also need to accept could have insane downside. You look at something like a Pokemon. If you invested into Pokemon in October or November, I'm sorry, you lost 50%. Unless you bought the Charizards on Pokemon, you bought October, November, you lost 50% of all the value. So you notice it's speculative. Now it could still go up and maybe in X years you'll have made more, cool. But again, if your entire portfolio is put into such assets, and when I say such assets, I mean the speculative ones. I'm talking the crypto. I'm talking the weird forex trading. I'm talking the stock calls, and I'm gonna do options trading. I'm gonna short this, I'm gonna short that, and I'm gonna do this and that. I'm gonna make 10x my money, and I'm gonna buy some Pokemon cards and some magic cards and some flesh and blood. If your entire strategy is built on all of these extremely momentum hype driven assets, well, again, some of these will do extremely well and have done extremely well. And so grabbing that upside may have value. But again, if you get into these assets at the wrong time, if you bought in October or November for Pokemon, maybe you bought fucking Champions Pack Charizards. If you enter those markets and you basically forego the tried and true, you're betting against the productivity of the global market going up over time compared to a bunch of stuff that has no tried and true value to it. You're essentially saying having $1 million in 30 years isn't good enough, because I believe that if I just put enough money into Pikachus, I'll have more quicker. I don't know. Maybe that's not very smart. I like those speculative things, they excite me. They have the potential for enormous upside, but you don't want to bet the entire farm for it. Again though, I'm just a dude. And maybe I'm wrong. Maybe the global markets completely change. There are people who believe that fiat currency as a whole will go away, the global markets will get destroyed because wealth inequality may lead to a point where the people who are disenfranchised because the inequality is getting so large will just say fuck the system and overthrow everything. They believe that therefore things won't get more productive because the people working are being treated unfairly. They will overthrow everything. How can it get more productive when the windows are getting smashed 24/7 and everything will just fall and capitalism will fail? And because of that, no one will trust banks and they won't even trust the Federal Reserve. And so holding up currency is impossible because the value of money is entirely dependent on how other people value it. And if that system falls apart, then no one can actually value anything anymore. And so they believe we'll go back to bartering. They believe gold will be the only standard of value again because for some reason it always has been. They believe crypto will be the way everyone trades, and basically everything will fall except for those commodities and gasoline and bullets. Again, maybe all of that plays out, and maybe none of the things I just spoke about will work like they have for the past centuries. Maybe that's also a possibility. You know, it just depends on what you're betting on. Are you betting on the systems and people in power to keep their power, or are you not? Again, that's some heavy political shit, and if you want to get into that, enjoy. I'm not even interested, but I'm going by the data, the long-term data. That is all. Like, subscribe, and I will see you soon. Ciao.